Thank you. A couple years ago, I asked my youngest daughter what she wanted to be for Halloween. She goes, I want to be an evil investment banker. I didn't have the heart to tell her I'd done investment banking for 13 years. But I have a good friend who's another one of us evil investment bankers, and he shared this with me. And it's from Marianne Williamson. It's called Our Deepest Fear. He says, our deepest fear is not that we are inadequate. Our deepest fear is that we are powerful beyond measure. It is our light, not our darkness, that most frightens us. We ask ourselves, who am I to be brilliant, gorgeous, talented, and fabulous? Actually, who are you not to be? You are a child of God. Our playing small doesn't serve the world. There is nothing enlightening about shrinking so that other people won't feel insecure around you. We are all meant to shine, as children do. We were born to make manifest the glory of God within us. It's not just in some of us, it's in every one. And as we let our own light shine, we unconsciously give other people permission to do the same. As we are liberated from our own fear, our presence automatically liberates others. Neat thought from an evil investment banker. Couple of things. The MoneyWise seminars, the Investment Banking Club Personal Finance Boot Camp starts tomorrow night. Again, we encourage you to come, especially if you're married. Bring a spouse, girlfriend, boyfriend, whatever you'd like. If you do go, it's 3 Wednesdays in a row. And if you go to all 3 of them, you'll get 3 credit hours toward that. If there's someone who's going to do that, what you do is as you go, you're mentors, and what we'll do is we'll talk for 45 minutes, and then I'll open it up for, if you have questions, raise your hand, and I said we'll have the mentors come around. Mentors will come around, and you'll just walk around and answer questions. And then 15 minutes later, then we'll start with the second one. So ideally, if you're married, I'd like you and your spouse to go to all 3. It's a good one. We hit what we call the 7 financial priorities. Rockin' man. So it's in room 251, 6:30 to 8:30. And we're doing another one. There'll be another MoneyWise seminar in March that will also be here. I think it's the married 4th stake or 6th stake or something like that. But I'll get that information for you. So encourage you if you want to do that. I think it'd be good. I got this email on Saturday. And I actually, he and I have been emailing all weekend. And I asked for permission, and he said I could use it. He says, Dear Mr. Cornea, regarding provide a way for people to learn about personal finance is a great service to people. I commend you on that. However, I find uncomfortable to read is the appropriate use of credit. That would seem to be a total contradiction in biblical principles. Proverbs 22:7 states that the borrower is servant to the lender. I don't know how a religious institution of higher learning would advocate the use of a credit card. And then it's quite a long email. It says at the bottom, there's not anywhere in the Bible that says debt is okay. I was thinking about attending, instead of BYU, he said bye, for a degree. But when I saw the philosophy on credit, I was quite disturbed about what I read. What do you think? How would you respond to that question? What do you think, Elliot?
Actually, I was going to say maybe like the parable of the talents, kind of because they're still kind of indebted, I guess, to Christ. And that's kind of the biblical story. So they're actually their money or talents, I guess.
Yeah, so the things that we have are really not ours, so we're indebted to Christ. Is his point valid? We shouldn't go into debt? Is what we've taught in this class, have we taught any place in the class about it's okay to go into debt except for what the prophets and apostles have said? So, so his point is valid. He makes some good points. So I responded this way. I said, thanks. I appreciate your email. I've reviewed it and have a few thoughts. I've had a credit card for 45 years. It's probably only been 30 years. And I have not paid $1 in interest except when I forget to make a payment. I call a credit card either the tool to help people achieve their financial goals and objectives or the single most destructive instrument in the history of mankind. Which is it? it depends on how you use it. Fire is the same type of tool, yet no one would say don't use fire, even though people can get burned. Other benefits of credit cards, and so, you know, he added all these points, and he was right. We don't have to have a credit card, but it does help us. I says, with a debit card and you lose it, you lose every dollar in your account. With a credit card, it's subject to the first 50. Debit card, you do not build credit. With a secured or even an unsecured card, you build credit. So I also says, you know, I've taken my wife and my 7 kids to Hawaii on frequent flyer miles. You know, and then I just said, if you read carefully what we teach, notice that we're not saying we should use a credit card for credit, only for convenience and for its purposes. We are not teaching to go in debt, exactly the opposite. Rather, we are helping people understand the rules of our financial environment and helping to use those rules to accomplish their personal and family goals. And I said, thank you for your comments. And I said, let's be careful we do not let our own view of what is biblical impinge on someone else's view, which might be slightly different. So, but it's kind of an interesting thought. So I actually went through and I re-emphasized the point. We're not saying credit cards to go into debt. In fact, I actually added a section that said, you know what, if you're one of these people who can't use open credit, don't use credit cards. If you find yourself going into debt, cut them up. But the point here is that we shouldn't be going debt. We shouldn't use credit cards to take us into debt. But I thought it was kind of, it was a fun interchange between me and this individual. Okay, let's talk about, today we're talking about consumer and mortgage loans. And so let's talk about our objectives. You know, loans, keep you types of consumer loans. So we'll talk about mainly their mortgage loans characteristics. So consumer loans and mortgage characteristics. And this is for your personal financial plan, student/consumer loans and debt reduction. What consumer loans and student loans do you have outstanding? I don't need numbers. You can say UCCU student loan, that's all I need. But what are your interest rates? What are your costs and your other fees? Other debts, what rate are you paying? Your costs and your fees. And then your action plan, what's your debt reduction strategy? What are your views on future debt? And I'd like you to be a little bit descriptive here on future debts. I had someone who just wrote, debt sucks. And that was a little bit too, not quite what I was searching for, but let's have a view on debt. Are there certain types of debt that it's okay? What do the prophets and apostles said? Education, modest home and for education. But other than that, we need to be careful. Okay. Here's the question. What questions should you ask when considering a loan? Let's just get into our groups and let's just spend 2 minutes on that. What questions should you ask when considering a loan?
And you pay like 5%. That's the way I think I've got the idea in my head. Sorry, you guys oh no, like what's I guess if there's anything what yeah what's the policy what's the I guess I don't think what's the did you go to high school? Is it a secured loan or not? Spot it every day? Are you an undergraduate? Yeah. I guess you're talking about home loan. Yeah, that's now that I really like that 60s, 80s.
Okay. What questions should you ask when considering a loan? Yes. How much of a down payment? And right now we're working more with consumer loans, but that's still a good question. Other questions? Eric. Penalties for early payoff. Okay. Other questions? Chris. Closing. Basically any fees, expenses. Cassie. Interest. And compounded. How is it compounded? Other thoughts? Gavin. Is it a want or need? Austin. Is it something you can wait and save for? Boy, the guy who wrote that email would love to hear our discussion today. Okay, what's the length? Oh, is it bringing you closer to or farther from your goals, including your goal of obedience to Heavenly Father's commandments? I think this is really a key one. I always like to kind of put things in perspective and say, no, I'm not going into debt. I'm spending my kids' education money, or I'm spending my kids' mission money, or I'm spending my retirement money. Does that put it in a little bit different perspective? And I think the answer is yes. What are the different types of consumer loans? Not mortgage loans, but what are the different types of consumer loans that you've either heard people use, or things like that? Why don't you just get in our groups for about 2 minutes there?
Yeah. So I don't ever have to pay the balance back. But you can spend over. You basically use your debit card like Yeah, and that's hard to ask.
Okay, what are some of the types of loans that we've either you've heard or you've... Go ahead. Types? Joni. So home equity. There's another one similar to that. Anyone heard this? It's called a HELOC. So where you actually don't take out the loan, but you're borrowing against it. Other types of loans. Jaron. Payday loans. Oh, my favorite. We'll talk about that one last. Josh. So auto loans, which is basically a secured loan. Student. You got secured versus, you've got subsidized versus unsubsidized.
We thought of like rent-to-own furniture.
Rent-to-own. I hadn't thought of that, but we could put that. And I told you my story about my personal loan. Skylar. Signature loan. Let's see if there's any other ones that I wanted us to get. And we can do these. We can also do single payment. We can also do installment loans. So lots of different types of loans. What I did is I went on to bankrate.com yesterday, and I just went through and did a number of different loans. So now we've got, notice, 36-month new car loan. What are we, about 3%? Notice this last one is this personal loan, and you're looking at about 7.5%. So secured versus unsecured. Now we've got home equity loans. So notice home equity loans, you're looking at about, what, 5%? And notice the first one is a $50,000. And what are you paying? Oh, it looks like we're almost paying exactly the same. You know, the 100,000, 50,000, they're about the same. It was interesting, a year or so back, the $100,000 loan was actually cheaper than the $50,000 loan. Any idea why that might have been the case? What are they trying to encourage you? To borrow more. But you can actually see how those rates have changed over time as well. I've given you a 5-year graph. Here's the HELOC. So a home equity loan, you're looking at about 5%. HELOC, you're looking at about 4%. What's the difference between those two? Skylar. Okay, so it's basically a loan against the equity in the home, and the home equity is actually, you're actually taking out another loan. So does it seem logical? Because the paperwork's less, they can give you a little bit lower interest rate. Here's student loans.
Oh, click the check.
Thank you. Here's student loans. On the right-hand side, we have a personal loan. Personal loan, notice they're around 8%. Left-hand side is the Stanford loan rate. What's that right now? After school, yeah, 6.8%. So if you can get the student loans, that's a lot better way to go. Here's auto loans. Auto loan, new car, 36-month new car, you're paying about 2.25%. 60-month, you're paying about this, about 2.25, maybe 2 3/8. So So bottom line is lots of loans out there. Lots of loans out there. You know, and the choice is you can either earn interest or you can pay it. Is it attractive to borrow at such cheap rates? Well, and why don't we do this? The stock market's earning 12%. This guy wrote this email, says, well, Dave Ramsey says the stock market earns 12%. I haven't seen that. You know, my calculations is probably between 7 and 9%. But we should borrow at 2% and invest in the stock market at 8%. I mean, that's a good financial thing. We're doing arbitrage. How risky is the stock market? Fairly risky, especially especially in short term. Over the long term, it's a great tool. But we need to be wise in what we do. Let's talk about a little bit the costs of consumer loans. How do we calculate? Let's say you've got a $1,000 loan. You're paying 10% interest on it. It's a single payment. And they're going to charge you $20 for a credit check. How do you calculate your APR on that? So that's what we want to do. We want to calculate our APR. What's the formula? Does anyone remember that? Something like this. It goes, it's your fees plus interest over the number of years divided by your average amount borrowed. Does this seem similar to what we did with leasing? So what's our interest on this loan here? 10% or how much? This is for 1 year. So $100 plus what are our fees? 20. What's our average amount borrowed? 1,000. So what's our APR? What is it? 12%. That's right. Now let's say instead of 1 year, now it's a 2-year loan. 2-year loan. Again, what's our new interest? How much do we pay in interest over these 2 years? Again, this is a single payment loan. So now we've got 2 years again. But now how many years? And what's our average amount borrowed? Yeah. So what's our new APR? 11%. Why is it 11% over 2 years and 12% over 1 year? Yeah, so we're spreading out the fees over 2 years. Okay, so this is called simple interest. It's the APR. Matt, glad you can make it. Okay. Now, what about an installment? So this is single payment. What happens when you do an installment loan? What's your simple interest method? And is that the same thing we do in our calculators? Have you guys built an amortization table? So we've got just a little thing here. We'll make our 10% interest. We'll put fees at $20. And we'll do $1,000. Now, again, remember how to do that amortization table? We start with, okay, first one is how much we owe. Our payment is calculated using a standard calculator. I just use the standard payment function. So notice E6. It's the payment, the amount divided by the number of periods. So your interest rate divided by your period, and here's month. C7 is the number of years, payments per year, and minus C5 is your amount. So it's just a standard calculation here. Then how do we calculate our interest? Our interest is just our principal times our interest rate divided by 12. So we'll pay $8.33 in interest. So our payment's $46, interest is $8.33. That means we paid off $37.81 in principal. So I subtract that principal, and that gives me my remaining principal, $962. I move $962 over here, and it's just exactly the same way. Then I can copy that over 24 periods. Notice we're bound to 0. And so remember the formula was your interest plus fees divided by the number of years divided by your average amount borrowed. Where do we get our average amount borrowed? Is it an easy calculation like a single payment? No, we can just but we can take an average. So here's our total interest divided by our average amount borrowed, and that gives us our interest rates. So notice if we take this $20 fee off here, it gives us our 10%. 11.86. That's our actual APR. How come it's more? How come it's more in this amortization loan than it is in that single payment? Of course, it's actually between a single. 1 year was 11% or 12%. The other year was 11%. I'll let you think about that.
Isn't that because the interest rate is compounded monthly?
Yeah,
of 10%?
we're compounded. Do you actually pay more interest or less interest this way than with the single payment?
You pay more interest this way with the same rate of percent.
How much did we pay with the 2-year loan?
It's 200.
We paid $200 in interest. How much are we paying here?
107.
107. So were we paying more or less interest? Significantly less interest. And yet, why is that APR higher? We'll let you think on that. Okay. Now, here's my favorite. Payday loans. So we've done single payment. We've done installment. How do we calculate the APR on a payday loan? Let's say, okay, you go into a payday lender and he says, you write me a check for $120. I'll cash it in 2 weeks. And I'll give you $100 today. You know, there's this band coming into Salt Lake. It's going to be an awesome band. You know, you and your girlfriend really want to go see it. You know, it's only $20. I mean, that's cheap. And you get to go see this greatest band around. In my day, it was, you know, Beach Boys and Seals and Crofts. That's how old I am. But you've got this. You write a check. You post-date it for 2 weeks. They'll give you $100 now. Oh, by the way, they didn't tell you that there is a $20 credit check fee and a $20 insurance fee. But how do we calculate our APR? Interest plus fees divided by the number of years. So how much interest are we going to pay? How many 2-week periods are there in a month or in a year? 26. So how much are we paying in interest? 26 times what? So it's 26 periods. How much are we paying? We're assuming that APR is your annual percentage rate. So if we held this for a loan, how many periods? 26 periods. And what's our interest for every 2-week period? What does that equal? 520. And then we add our fees. And what's the average amount borrowed? Now, there are rules that say, you know, the payday lenders rules that say if you don't pay it back, what do they do to your interest rate? They jack it up. There's also rules that say that you can't do this more than 6 periods. So what's our APR on this? Is it 56%? 560%. Now, what are you guys making on your savings account? 5 basis points, 0.05%. We're in the wrong business. I actually have a friend who used to be in this business. And what's the default rate on these loans? 20 to 35%. But he said, we could double the interest rate and would still have more demand than we can handle. And that's because people haven't learned to discipline their finances. Now, wait a second. Okay, let's go back, though. And let's say, you guys remember that effective interest rate calculation? Remember 1 plus your APR divided by the number of periods to the number of periods minus 1? Let's be nice, and we'll even take off this 40%. So let's just say it's that same 520%, which is what I've seen when I've gone into these payday lenders. That's how boring I am. When I get bored, I'll walk into a payday lender. So how do you calculate that effective interest rate? So you guys remember how to do it? It's 1 plus 5.2. How many periods? 26. Remember, this is a year. 26 minus 1. So what is that rate there? And you're going to think it's wrong. Grant, what number do you got?
I have 114.48.
1, 4. If you could effectively do that. I know it seems wrong, but it's not. Payday loans, good idea or bad idea? This is from a person I worked with after he paid off his payday loan. He says, the phrase, all that glitters is not gold, comes to mind as I describe the pitfall of payday loans and check advance establishments. To start, from time to time, there seems to be some type of emergency or you become a little short on money. No emergency fund. If you haven't saved up money in the bank for whatever reason, a loan seems the only way to go. This is where it all starts. You get this false relief that you can get a loan to get you by till the next payday. It's only a week and the interest can be bearable enough till that day. A compounded emergency or unforeseen need comes up, no savings, and you have to pay off interest. Here's where it gets worse. Now you feel yourself getting stuck, and now you get sucked into frustration. Rationalization seems your only comfort. This is where you start getting robbed. If you don't pay it off, then it crashes into the checking account. The next downside, the needs of a family member are not met because you have to pay off this stupid loan. Daughter needs jeans, a pair of shoes, a long-awaited family outing can't be taken because there's no money in the budget because you have to pay off a bad loan with awful interest. You feel sickened and you lament because this seems to take a significant part of your income for the month. These loan companies are called bottom feeders, like loan sharks without guibo and broken fingers. I hate them. So enough is enough. Get help and support to get yourself out of the situation because it can come to a point that you can't do it alone anymore. Moral support is key. True financial independence is far greater than the false glitter of fake love for reading use only permission granted. I grew up in a little town in California, and we used to joke, friends don't let friends drive Chevys, and my friends who had Chevys would say, friends don't let friends, drive Fords. Be careful. And as you work with people, help them to see the challenges and the risks of these type of loans. Again, you'd think, I don't know who you think the people who use these, but I'm amazed at the number of people, doctors, lawyers, professors, things like that who use them. So what we need to do is get our finances in order and make sure we understand that. So any questions on consumer loans? So now what we'll do is we'll move on to mortgage loans. Mortgage loans are more fun anyway. So let's go back at our group. What are the major types of mortgage loans? Let's just take. Is there only one type? Or are there multiple types? Why don't we take just a minute or two and let's talk about the different types of mortgage loans. Okay, what are the main types? Probably the easiest one. Fixed. What's another option we could go?
Interest only.
You can go ARM, adjustable rate mortgage. Other ones? Yes. Yeah, you can do a balloon. Balloon are mainly things like construction loans. When we built our house in Walnut Creek, we took out a balloon loan. And the reason we did that is I wanted the bank to make sure our contractor was following consistent with the schedules. How about other ones? Other options? You could do an interest only. And an interest only is an option. And it's an option on a fixed or an adjustable rate mortgage. And so what it does, it allows you to pay interest only. So here's your principal. It allows you to pay interest only for a certain period of time, maybe 5 years, maybe 10 years. But what happens after that interest only period ends? And this is what people don't realize. Right, so now you have a 30-year, you paid interest only for 10 years. Now you have a 30-year loan that you've had interest only for 10 years, and now you have to pay off a 30-year loan in 20 years. What does that do to your payments? Substantially higher. Now you can get an interest only on a fixed or an ARM. Okay, other options? Anyone heard of this one here? 5 years ago, this is all you heard of. It's an option ARM. You probably can't get them very much now. Go ahead.
So my brother was branch manager in a mortgage office.
Uh-huh.
That was like their most common thing because the loan officers could make 3 points on every loan and the borrower didn't care because all they looked at was the minimum payment.
Right.
But the loan officers were getting paid on the.
So what did loan officers push? You're talking option ARMs.
So they definitely pushed it, and they were kind of. So I worked at the office too after I got commission, and the idea was that we would connect them with a financial planner, financial advisor,
Uh-huh.
to help them to take the money that they saved by making the minimum payment and invest it and make more than they would have, if they had paid the other way. So I mean,
How many people actually did that?
zero. But it was what everyone was doing. And
That was an education.
a lot of loan officers
So, right, a lot of loan officers made a lot of money, and that's why they call these, it says, nightmare mortgages. They promise the American dream, a home of your own with ultra-low rates and payments anyone can afford. Now the trap is sprung. So luckily you can't get those now, but here's the cool thing. Here's what it was. Here's the selling point. You know what, this is an option ARM. You can actually make a minimum payment. And this was lower than the interest-only payment. You can make an interest-only payment, or you can make a regular payment, or basically any amount, as long as you made that minimum payment. But that minimum payment was less than enough to cover the interest. So what did that do to the loan balance? What's it called? Negative amortization. So if you only made the minimum payments, then the value, the loan balance continued to grow. And so the scary thing about this is there was a lot of people, but what they didn't realize, after you hit some limit, say 125%, this loan reset and became a fully conforming loan. So if it hit 125% after 15 years, you had 10 years to pay off a 15 years to pay off a 30-year loan. Guess what that did to your payments? Huge things. And then you've got a couple of other options. You've got special, what we call special loans. And then you've got like your VA loan, which is insurance, or an FHA loan, which is for other people. Jared. Uh-huh. Yeah. Uh-huh. And they did. So we got the agency.
Sell it because they can sell it off on the.
So the reason,
Securities that love the risk.
yeah. And so with an option arm, so your minimum payment was probably $300 less. So you could, for a borrower, you could get a lot bigger house. People weren't looking at the amount that they were borrowing. They were looking at how much they could do. Skylar. Right. So, you know, real estate always goes up, right? Just like the stock market always goes up, right? So these are the things that people were saying. And the challenge is that wasn't reality. So let's just kind of go through. So when it comes here, when you choose your loan options, you need to understand a few things. Number one, what is your time horizon? How long do you expect to stay in the house? What is your requirements for low required payments? You know, is your job a good solid job, or is your income volatile? What's your tolerance for interest rate risk? Are you willing to assume that? What's your work status / history? Have you been a member of the armed forces? Because these things will have an impact. So a couple of things. Conventional loans, they're neither insured nor guaranteed. There's a maximum set by Fannie Mae and Freddie Mac, and I think the numbers are the same for 2012. They require private mortgage insurance. So if your down payment is less than 20%, you have to pay private mortgage insurance. Now, what private mortgage insurance is insurance to, if you don't make the payments, then the insurer will. So if you want to reduce your mortgage costs, pay 20%. Now, who determines when you have 20% equity in the home? You actually have to do that. So in our house in Walnut Creek, after we had 20% equity in the home, part of it was paying down, part of it was the market appreciating. We actually had to go out and get an appraiser come in. They appraised it, showed that we had 20% equity. We sent it into the mortgage servicer, and then we had that PMI taken off. And that was like $150 a month. So it was close to a couple of thousand. We have what are called conventional loan limits. So the 417 is the same in 2000. The 50% higher Alaska, Guam, Hawaii, Virgin Islands. And then you've got jumbo loans. And so a jumbo loan is basically anything beyond this 416,000. It's also used to refer to anything above $500,000. And you've got piggyback loans. Why would someone do a piggyback loan? And again, to eliminate that need for private mortgage insurance. So that's been done. And so these are the things we're going to talk about. Fixed rate, variable, interest only, option adjusted, negative AM, balloon, reverse, and special loans. So fixed rate mortgages, least risky. This is what I would recommend for each of you here. Most recommended option. Positives are these. Higher monthly payments, basically so you're paying down a greater principal. No risk of negative amortization. And who handles the interest rate risk? The lender. What are rates right now? Yeah, they're amazingly low. Interest rates are higher. Higher monthly payments may make it difficult to make payments if you're not on a regular salary. Take a look at this. Here's the 30-year loan, 3.5. 15-year loan, roughly around 3. Why is the interest rate lower on a 15-year loan? Yeah, they pay it back. They've got their principal back faster, so there's less time risk here. Now we've got adjustable, again, interest that's pegged to a certain index. And generally, there's a floor and a ceiling that says how much you can go. Often what they do is they have a fixed rate of interest for a certain period of time, 3-1. So for the first 3 years, it's fixed, and after that, it adjusts every year, 7-1. First 7 years, it's fixed and adjusts after that. Again, lower rates, lower monthly payments. Yes?
I was just going to ask, for an arm with you, if you know you're going to move in 3 to 5 years, would it be a reasonable option to
You could.
and then try and sell off?
You could. That's a possibility. And the question is, we think we're going to go in 3 to 5 years, and do we actually do that? And so what I would do is I would look at the differential. So remember those rates now? So an ARM is 3.4. And what was for a 3-1 ARM is about 3.4%, maybe 3.3. And I told you my story of my friends who got a 30-year fix for 3.3. Of course, they were very good negotiators. And we'll give you some strategies to help you. Notice that 7-1 ARM is about 3.2. So what's the difference between a fixed and an ARM right now? About 20 basis points, maybe 30 basis points. Are you willing to take that risk for 30 years of not having to worry about the interest rate side? Again, I strongly recommend the fixed right now. And now you've got an interest-only option. So what the option is it's an option on a loan that allows you to pay interest for a certain period of time. Again, what people think, it's just like a credit card, a minimum payment on a credit card, and that's not the case. If you do an interest-only option for 10 years, now you've got 20 years to pay back a 30-year loan, and it has a big impact. Cassie?
What if you do an interest-only loan and you pay more than that minimum payment? Will that go straight to principal?
Yes, you can.
Could that possibly be a good idea because then you're...
Yeah, the other option is just do a standard one, and you can also pay that as well, too.
And that would be better?
Yeah, you probably have a little bit lower interest rate. So benefits, lower monthly payments, greater flexibility, helpful if you have a better use for the money elsewhere. And your comment there, how many people actually went to the financial planner and invested that money elsewhere? They all bought cars and boats, which is the sad thing. The risk, there's a huge rise in payments when the interest period ends. There's no amortization of principal. You've got to assume some appreciation to pay it off. And most do not have the discipline to invest savings from principal elsewhere. So notice what the rates are in interest only, 3.7. 3-1 ARM interest only, 7-1, 3.5. Attractive rates, scary rates. And now this is the really, we call these nuclear loans. Interest rate adjusts monthly, payments annually with options on the payment amount. And then the minimum payment, which is less than the interest-only payment. So the minimum payment requires negative amortization. Once this maximum is reached, payments are automatically increased. So the loan becomes fully amortizing and causing an increase in payment. So these are, again, things not recommended. Option R's benefits, the risk, payment shocks. And we'll do a problem here just to show you how huge that payment shock could be. And most don't have the discipline to invest savings from principal elsewhere. They spend it on the cars and the boats and the other things here. Then we have negative amortization loans, loans that payments are insufficient to amortize. The thing to realize is with most of these loans, once you hit a certain negative amortization limit, the loan automatically resets and you have to pay it off. And so there's a significant increase. We talked about balloon mortgages. A lot of times people will build a house. Like I said, we built a house. We did a balloon mortgage just so we could have the bank making sure our contractor was doing things according to schedule. And he was. And then reverse mortgages. You've heard about these. People who have big houses, no cash. There's been some problems with these. The good news is we're seeing increased regulation to make sure that people get a more fair deal for it. And then we've got special loans, insured loans. FHA, it doesn't originate the loans, but it insures the loans. Notice there's lower PMI insurance, but instead of being required only for the first 20%, it's required for the entire life of the loan. And realize the required down payment is low, the maximum amount. So here's FHA loan, you're paying about what would you say, 3.4? It's probably pretty close to the fixed. Generally, it's a little bit more than the fixed. And then we've got VA loans, which are guaranteed. And you can see that is you're paying 30-year, we're paying what, 3.5, probably close to the same. So a lot of things we need to understand. So the question is, how do we reduce our borrowing costs? How do we know if we get a good mortgage loan or not? And we'll talk about this on Thursday. How do we know? Yes?
A lot of the rates are publicly available.
Right. So if we get a low interest rate.
So, and you can see on your paperwork that the loan officer will provide you how much your loan officer is making on you, either on the front or the back.
So, right, the good faith estimates, you can actually see how much they're making. So if we look at our fees, if we look at our interest rates, we can actually get a sense. So how do you reduce your borrowing costs? What are some of the things we can do?
A higher credit score.
A high credit score. You can pick a higher down payment because what you're doing is you're reducing the lender's risk. What's generally the relationship between interest rates and time? Longer the time period, the higher the interest rate. So can you shorten the period? You could do that. How about there's a whole bunch of clauses in those insurance contracts. Are any of those clauses in your favor? No, you got to have insurance and things like this. Life insurance.
With those clauses, if they're in there, can you say, can you take this out, or how do you go about
You don't really have a choice because you're the borrower. Yeah, be aware that they're there. So let's talk about most expensive to least expensive. What's the least expensive type of borrowing? Yeah, bank of mom and dad, if they'll do that. Then what's the next? Yeah, probably home equity loans, other secured loans, more expensive credit unions, savings and loan commercial banks, most expensive credit card, retail, finance companies, and payday loans. And ideally, since our goal is to be wise stewards over the blessings we've been blessed with, we want to take the time to understand. Okay, let's do a few cases. I got a little bit of time. Do we need to do the, you know what? Let's not do this one. Let's go on to the next one. Okay, let's just do that. We'll do one. The mortgage ones are so much more fun. Let's. I'm changing this to here. We'll do the. Okay, let's start here, and then we'll go from here. Wayne's concerned about his variable mortgage. How much could it rate rise over the next 4 years if he had a 6% variable rate mortgage, 2% annual cap that he hits each year, and a 6% lifetime cap? How would this affect his monthly payments? So you have what's called, with an ARM, you've got an annual cap, which is the maximum it can rise each year, a lifetime cap, which is the maximum that it can rise over the life of the loan. Assuming he hits it each year, 6% lifetime cap, what would his new interest rate be in year 4? 12%. What would that do to what would that do? Can you imagine, assuming a 6% interest rate and all of a sudden it moves up to 12%? That would be tough. So significantly, I could have, it would significantly increase his monthly payment. How about this one here? Ann's looking at a mortgage cost, $30,000, $300,000, traditional fixed rate, 6% 30-year amortizing loan versus a 7% 30-year loan with a 10-year interest-only option. What are our monthly payments for each year for the first 10 years? What is her new monthly payment beginning in year 11 after the interest-only period ends? And how much did they rise in percentage term for the interest-only loan? So how do we calculate our interest-only payments? Is there any amortization? No. So what's her interest-only payment? So how do we calculate that? 300,000 times 7%. And what did you get, Cassie? Then divided by 12. So 1750 is her interest-only option. How do you calculate the rate for the fixed rate? You have to use your calculators. You have to use the payment function. So why don't you do that? Let's spend a couple of minutes in your groups and let's do that. Let's do A, B, and C. Right. But this, I used an extreme case, so 6% traditional, 7% interest. But
So 300,000 over 20. But it's amortized, so it's still paying interest.
So I did 6%. Oh, 1 second.
So how do you calculate the payment in year 11? So it's 20 years, that's right. And from 30 years to 20 years. Did you get the increase, Tyler? Yeah. So monthly payment rise from the interest-only loan. So it went from here's 1750 is the first one. So how much did Ann's monthly payment? Interest-only loan. Right, 1750, so what the new one is. How much did it increase? Yes. Do we want a little bit more time, or do we want to go through it? Oh, okay. Some people are tired with this one. Okay, so let's someone want to take me through it? So how did you calculate the monthly payments? Grant, you got your calculator. What did you guys come up with? You can take as many helplines as you want.
So for the traditional?
Okay, traditional.
Take the 6% divided by 12.
Okay.
Monthly interest rate. And you take that.
Some of your calculators will do that automatically.
And then your number of payments is 360 for the 30-year loan. Then you have present value is 300,000. Your payment is 1798.
Okay, 65. And Grant, how did you get your interest only?
So we already figured out the interest. Then for the rest of it, we have the 7% divided by 12 is your interest. And your number of payments is 240. 12 months times 20 years.
Okay.
And I think our answer was 23, 25.
Well, for the interest-only period, we just calculate. Oh, you're doing Part B. Okay, so here's the, okay, then for Part B, and what did you get?
23, 25.
23.25. And what was the increase? What was it? 33%. Can you imagine having your, probably one of your largest expenses increased by 33%? Okay, that's scary. Okay, let's do another one that's even more scary. This is the option arm. So realize 30,000 30-year option arm has 7% mortgage. He could make a minimum payment of $1,317, which did not cover interest costs. Interest-only payment of $1,750, a payment of $1,996, principal and interest, or an additional amount. It had a negative amortization value of 125% of the value alone. So John was not very financially savvy. For the first 10 years, he made the minimum payment only. As a result, at the end of year 10, he was told he hit the negative amortization maximum and his loan has been reset. What is his new monthly payment beginning in year 11 after he hit the negative amortization limit? And how much did it rise over the minimum payment he was paying previously? Do we understand the problem? Okay, so the loan was $300,000. For 10 years, he only made the minimum payment. So, and that loan has a 125% limit. So at year 10, what is his new loan amount? It's not $300,000. Pardon me? So it's $375,000 now, because negative amortization had increased the value of the loan by $75,000. So now, how many years does he have to pay off this loan? 20 years. It still is 7% interest. So why don't you go to your groups and spend a couple of minutes? And now you can see why we call these nuclear loans, Phoebe.
There's just so many factors that go into it.
Do you see why these are so scary? Do you see why they're called nightmare loans? Someone want to take me through the analysis? Do we want a little bit more time? Let's give you one more minute. Then we'll let you take us through the analysis. Okay, Jacob, you want to take us through it?
Yes, so it was a $300,000 mortgage, and then at the end of the 10 years, it hit the maximum, which was 125%. So just multiply 30,000 times 1.25.
Okay.
375,000.
So now the new loan amount becomes 375,000. Okay.
So that's your present value, and then 7%, 240 months, and then that came out to $2,907.
Okay. So 375. Now he has to pay it off in 20 years. So now his you got 2,907? Okay. So what was his previous payment before? Previous payment was 13. His new payment is 2,907. What's that an increase? Yeah, 121%. Can you imagine that, though? Can you imagine having that type of an increase? What would that do to your budget? And so hopefully you get a sense that I like fixed rates right now, number one, just because the differential between the fixed rate and the ARM is very tiny. But I like it because it helps in the budgeting process. 121% increase over the period. I got another couple of minutes. Let's see. Well, you know, so kind of in summary today, what we've done, we've talked a lot about consumer loans. And probably the most important thing on those consumer loans, when you're thinking about those consumer loans, you got to ask yourself the question, you know, is it a need versus a want? All those things we talked about. But probably the most important thing is, will this take me closer to or farther from my personal and family goals, including my goal to be obedient to the commandment to get and stay out of debt. I also like to think on a little bit differently too. When we're thinking about going into debt, don't think about this as I'm going into debt. Think about this as I'm paying, you know, this is my retirement money. I'm spending my retirement money. I'm spending my kids' education money. I'm spending my kids' mission money. Would that make a little bit different in our view? And I think it would. So I think if we take a long-term perspective on each of these things, we'll make a difference. We also talked about the mortgage loans, fixed, variable, option, interest-only option, option ARMs. We'll actually spend a little bit of time on Thursday talking about how do you decide which of these to take. So you already know my preference toward the fixed rate mortgages right now. Thanks, everybody. We'll see you on Thursday.